Okay, well, welcome to everyone. I'm basically sitting here from my IPS office. It's another webinar for us, and what we're doing is we're focusing tonight on Australia and the opportunities that we've got in amongst Australia. Now, the biggest thing for me when one's looking at a market is to understand what's happening within that market, to understand the opportunities, to understand the fundamentals, and then ultimately one can look at providing a solution and how one can actually invest into that market. So, without further ado, what I'd like to do is to begin a presentation where we're going to very much look at the Australian market. We're going to look at the opportunities within the Australian market, and then really, once we've done that, we'll look at the ways that one can actually get involved if one wants to. So let's look at changing the screen there and putting you onto the PowerPoint presentation. Right, so running along from the PowerPoint presentation, my question to you is Australia. Why should you invest in Australia, and particularly why should you invest in Australia now? There really is a fundamental issue that people need to understand, and at the moment is a perfect situation, particularly for South Africans, to be looking at the Australian market, and I want to answer that question. Before I actually get into it, I just want to look at this little screen, just so that if you're unused to webinars, you can understand how it works. Basically, the main blue screen, that's obviously the physical PowerPoint screen. On the right-hand side, you can see that there's a little hand button there. If you put that up, it basically alerts me. You can also write questions. So in this question box, you can put in questions and I can see what's going on. And then also, obviously, you've got the audio and you can see what's happening with regards to the screen, and you can change things as and when you need them, basically. So it really helps you to understand how the process is working. So that hopefully gives you a good idea. Let's move on now with regards to the presentation. That is a question I ask everyone. What is that picture? And, they look at it and they wonder for a while, and if anyone, online has a view as to what it is, a lot of people will say dinner, a lot of people will say food. For me, what I was trying to capture there is a good old Sunday roast. And the question I would ask you is, what do you need to do to have a good dinner or a good meal? A lot of people would look at me and they'd say, well, Scott, you need good food or you need a good chef. But, I think the most important thing, if you answer that question, and particularly those people that prepare a great Sunday roast, would tell you that it's actually preparation that determines how much you enjoy that experience. And what I want to show you here is that whether you want to live in South Africa for the rest of your life, preparation now will determine how good your experience will be in future. And even more importantly, if you're looking to move to Australia, preparation now will really assist you in enjoying your experience once you're actually living in Australia. There's some great advantages to buying in Australia prior to actually immigrating to Australia. When one looks at it, the first one is tax and depreciation. I'll pull up the schedule. You can own a cash flow positive property in Australia, and the great thing is that because you can take into account the depreciation, because you can see that it's actually cash flow positive from day one, but you take into account the depreciation on construction, the depreciation on fixtures and fittings, you take acquisition costs, and you can even include an inspection trip once a year over to Australia to go and view your property. But this property, at an average cost of around $400,000, is getting you an accumulated tax loss of roughly $16,000. Now, if you own a property here in South Africa and it costs you 10,000 Rand a month, and your rental is 6,000 Rand a month, there's nothing you can do in terms of that loss because it's effectively ring-fenced. But in Australia, you can accumulate that tax loss. If you move to Australia, say you move in 3 years' time, you're going to have a tax loss of between $45,000 to $50,000, and you don't pay a cent in income tax until you've paid off that accumulated tax loss. If you never move to Australia, you can still offset it against capital gains tax. I tend to say to people, it's a bit like going to the casino. You can bet on red or black, and you win both ways. The second thing that's very important is with regards to immigration. There's 3 ways to get into Australia. One is by having the skills that the country needs. The second is on a business visa, and the third is on effectively a buy-your-way-in visa. Now, basically, with regards to the skills-based visa, it doesn't actually get you extra points, but it certainly shows you intent to invest in the country. On a business-based visa, you need to invest $250,000 into Australia, and buying a property and investing money in property is actually one of the 3 key things that you need to do. And again, in a buy your own visa, you need to put 1.2 million Aussie dollars into the economy. And again, a property will assist you with regards to your immigration. In terms of your credit rating, a lot of people underestimate how important the credit rating actually is. And I want to just explain that to you and show you basically what you're actually looking at. But the most important thing with a credit rating is to explain my own personal situation. I came back from London. I had a number of properties here in South Africa. I had the rent coming in, the mortgage going out, and the great thing was that the banks basically had a financial record of me. So I could get car finance, I got a mobile phone, I had no problems with getting contracts, etc., etc. My uncle, on the other hand, moved from Brisbane from Harare to Brisbane. He bought a $1.3 million Aussie house for cash, and he couldn't get a mobile phone contract or a credit card for nearly a year. And the reason being he had no credit rating in Australia. So buying a property prior to moving there is really, really good with regards to setting up that credit rating. And the final one, and what often people see as a really, really important one, is that buying an investment property now, buying a property where you're getting the best capital growth in the area with the best rental demand and therefore getting the best return on your investment, can ultimately help you actually set up buying your dream home. I tend to say to people, how soon is it until you're leaving? And they might say to me 6 to 12 months. Well, you know, even when you arrive, I would highly recommend that you rent for at least another 12 months so that you can work out what suburb you want to live in, where you want to live. And so that basically means that the best case scenario, you're going to be out of the property market for 18 to 24 months. So you can get all the advantages I've spoken of above, plus all the property advantages. But when you're finally ready to buy your dream home, I would suggest you get in a car with the best estate agent in the suburb that you want to buy, and you go and find your dream home. The beauty is that this investment property that you bought as a non-resident, you can get 70 to 80% financing. When you're living in Australia, you can change that to 90% financing. So you can release a 20% deposit, which basically enables you to buy your dream home. And I think it's such an important understanding to come into play. So, you know, the question I would say, when you look at those options and how positive they are, why would you not do it today? It makes perfect sense, basically. You know, would you actually look at it? And many people would say no, and therefore I would ask you, why not? I mean, what are your reasons for not acting upon them today? So now that you've thought about those, you know, some of the reasons that we get all the time, and the question I was to ask you, if I was to give you comfort with those reasons, would you actually look at investing in Australian property in the very near future, if not even today? Let's look at some of those things. I want to go to Australia to choose the right investment. You know, I ask people straight away, if you lived in Sandton and someone came over from Sydney, what would be the chance of them actually trying to find a good investment in or around Sandton? You know, there's basically, you know, very little chance of them understanding what's happening with regards to the population, the growth, the infrastructure, where businesses, where people want to live and work. You know, there's very little chance of them actually finding a good investment in a couple of days or a week. You know, we, on the other hand, work with our strategic partners over there. They full-time are analyzing the market, analyzing which state has the best growth, where the population growth is, where the infrastructure is, where the best schools are, where the roads are being built, where the job opportunities are. And these fundamental criteria are so important. We've actually got a 100-point system to choose the best areas so that we determine where the best capital growth is and where the best rental demand is. And that is the type of information that we can share with you. And you know, with all due respect, quite happy for you to get on an airplane. We've got our people on the ground there in Australia that can show you around. But that research to finding a good investment has been done for you already. I'm worried about the management and maintenance of my investment. It's so far away. What can I do if there's problems? A lot of people say to me all the time, well, you know, what happens if the tap leaks? You know, I don't want to call that the toilet's leaking at midnight. We've partnered with a management company. They've been in business since 1987, and they were actually set up to help Australian Defence Force people invest in Australian property. So whether it was, you know, a guy sitting in the Mediterranean on a boat or a soldier sitting in a tent in Afghanistan, they wanted to provide a solution. And there's two problems that they foresaw. The first one was this maintenance and management. So they set up a management company so that they could totally look after the management and the maintenance for people that were away from their home. And the next question that they basically brought up is one that people often ask: what happens if my tenant doesn't pay my rent? How can I afford my mortgage? So what they did was they actually came up with their 10-year lease back. which is a great and very simple system to provide you, the investor, with the comfort that you will get your rental income each and every month on the 10th of the month. Basically, it's quite simple. You've got the developer, you've got Ozinvest, the management company, and you've got the investor. Before the investor actually buys the property from the developer, they sign a lease agreement with Ozinvest, and Ozinvest guarantees them to pay a market-related rental each and every month on the 10th of the month for 10 years. They then go out and sublease the property to the tenants. They've been in business since 1987. They've got over 1,000 properties under management, so they can really statistically manage their voids. But also, just so you understand how it works, they charge $15 a week times 1,000 properties. That's $15,000 a week. And it really provides them with a little bit of a buffer should a couple of properties be unlet. But for you, the investor, it guarantees your income. But it's a win-win scenario because they're also making money. And so after the 10 years, they're quite happy to renew it and continue it. The other thing that I think is very important here, and it's a safety net that hit me like a ton of bricks when I understood it. When you're dealing with most property people, they'll do their research and they'll tell you which areas to invest in. But ultimately, at the end of the day, when you get the keys, that's your problem. Whether you've got a tenant or not, it's your problem. With Ozinvest, they put their money where their mouth is. They sign a lease agreement with you before you actually take ownership of that property. So from the day that you own that property, they become your tenant, and you're guaranteed at market-related rental each and every month on the 10th of the month. Ultimately, understand how important the safety net is, because it is effectively they are putting their money where their mouth is. If they are not helping you buy in the best areas with the best capital growth and most importantly the best rental demand, they are losing money. And that's such an important fundamental for you to understand, and it's the reason why IPS strategically partnered with them. And the fourth major concern that people have is what happens if interest rates go up. The beauty in Australia is that you can actually fix your interest rates for 5 to 10 years. That's fantastic because, you know, when you look at it, I believe that there's three fundamentals to property. The first one that one's looking at when one's looking at property is effectively your expenses. So that's your interest rates. And the beauty here is that you can actually fix your interest rates. The second one is your income. Now with most property, you can't actually guarantee your income. But here with Ozinvest, your income is guaranteed for 10 years and beyond should you wish to continue within their scheme. And the third one is capital growth. And the only way that you can beat the statistics with capital growth is to make sure that the research has been done. And we do a very detailed and thorough analysis of the best areas within Australia. You know, to give you an example, right now some areas, for example Perth, have really struggled with regards to capital growth. There's an oversupply of properties and therefore we don't recommend properties there. Another example is that Ozinvest has struggled with apartments. You know, with regards to there's a quicker turnover of tenants, your yields are lower, so they don't recommend those properties. And the reason being, they put their money where their mouth is. They help you invest in property where you're getting the best returns. And I think that is so important to understand. So, moving along, I want to focus on why you should be looking at property. The first one is the economy and what it actually has, you know, in terms of what is happening within the Australian economy. The second one is the fundamentals of the Australian property market. And the third one is the immigration factor. Just to touch on the immigration factor, over 2 million people every single year apply to go and live in Australia. Only 177,000 people on average get into Australia. Now one needs to understand that there's only two ways to get into Australia. You either have money or you have skills they want. Therefore, this country is just getting stronger and stronger and stronger. And one needs to understand the impact that that is going to have on both the economy and the property market in the medium to long term. When one looks at the economy as a whole, you can see here from this graph that the red line is the OECD, so effectively the first world economies. The gray line, it actually is the developing countries, and it basically includes China, Brazil, India, Russia. And you can see that they are going to be the factors that are going to drive growth amongst the world economy over the next 5 to 10 years. Now the impact that this has on Australia, Australia is geographically positioned closest to the Chinese growth. There's huge stimulus packages taking place within China to make sure that their economy continues along the growth projections that they're wanting. And this has a huge impact and stimulus on the Australian economy. The second thing that's very important is that their banks, if you take the top 100 banks in the world, out of the top 15, the top 4 Australian banks are in the top 15 banks in the world. And it's so important to understand the impact that it has on confidence and the stability of both the Australian mindset and the Australian economy. Less than 1% of their loans have been non-performing, and they haven't been affected by the subprime crisis. Very similar to South Africa, where they had restrictions so the banks couldn't go and get involved in Europe and America with what's happened. Obviously, it's had an impact with regards to liquidity and lending, but they haven't been directly affected. They had far stricter controls with regards to people borrowing money in Australia. The big difference is when you look at this graph, it basically takes into account the US, the UK, and Australia. And you can see here this blue line. This is the amount that the interest rates have dropped over the last 12 months in the US. This is the UK, and this is Australia. So even though Australia has dropped its interest rates from 8.75% to 3.25%. The difference between the US and the UK is that the banks have not passed that on to the man in the street. I mean, look how despicable it is in the US and how the banks have held on to the margins. The same in the UK. But yet in Australia, the banks have passed that on to the man in the street. And what it's basically meant is that in the US and the UK, the property markets have continued to go down because even if people wanted to buy property, they haven't been able to get mortgages. Whereas in Australia, it's been passed on to the man in the street, and therefore the man in the street has been able to borrow. The man in the street has been able to buy, and the man in the street has also been impacted directly with regards to their affordability with the interest rates coming down. When one takes the property market, the 100-year average in growth in Australia is 8.7%. In 2007-2008, the national average was 12.3%. The property market tends to grow fastest in the coastal regions, and a very interesting statistic is something like 75% of the population lives on the eastern seaboard and within 100 kilometers of the coastline. Residential real estate represents 2/3 of the total property value, and something that's very interesting is that the land component represents about 2/3 of the total property purchase. In South Africa, the land component represents about 1/3 of the total property purchase. 64% of people currently own their own home, but they expect that by 2050 to be around 50%. It's very important to understand these trends for you as an investor. And then finally, they've got FIRB, which is their Foreign Investment Review Board, and it basically stipulates that you as a non-resident can only buy new property. So you can buy a piece of land, you can buy a house, or you can buy an apartment, but you can only buy new from a developer. You can't get on a plane, go over and buy an old dilapidated house from a granny. When one looks at the difference between the Australian market and the US market, you can see here this graph shows you the huge oversupply that they've had in property in America. Now the problem that they've had in America, when one looks at it, is that in America you've got supply there and you've got demand there. And the only way that these are going to get back into equilibrium is if prices actually come down, and they will get back into equilibrium. There's over 1 million houses in America where supply has outstretched demand. Now the big difference that you've got in Australia is that it's the other way around. Demand has actually outstripped supply, and supply cannot keep up with the demand. And when one looks at this graph, it will show you what I mean, because it's very important to take this into account. The population growth in Australia last year was 317,000 people. The average over the next 10 years is going to be 294,000 people. So when one considers what that needs in terms of requirement for houses, the average number of houses that they need over the next 10 years is 182,500 houses every year. At current, they're only being able to build around 153,000 homes, which is 32% short. And you know, ladies and gentlemen, a lot of people say to me, well, why don't they just build more houses? The reason is they've got a skills shortage. They don't have enough brickies or carpenters or artisans that actually can build these houses. And the problem that you've got is that the discrepancy between demand and supply is just getting further and further out of kilter. And the impact that that's going to have for the man in the street is that when you understand the fundamentals, it's going to increase the demand for property, which will increase prices, and it'll also increase the demand for rental. The next thing that's very important to take into account is the interest rates. I specifically used a graph here that I had from the middle of last year because this was the prediction on what was going to happen with interest rates. The first thing that's very important to take into account is that from December 01 to September 08, interest rates actually went up. Now, you know what an impact it's had here in South Africa when interest rates only went up for 2 years. Well, imagine what had happened in Australia where it went up for 7 years. On this graph, they were expecting that around December 2007, the interest rate would peak and then it would come down to around 5.5%. What has actually happened is that interest rates continued to go up and they went up to 8.25%. In September 08, it was the first time that they dropped interest rates, and they've dropped them so dramatically over the last 4 or 5 months. They actually dropped 64% to 3.25%. They've had 2 interest rate meetings since where they've held the interest rate, but there is talk that by the end of the year it'll come down a further 0.75% or 75 basis points, and the base rate will be in the region of 2.5%, which will be some of the lowest it's been ever in the Australian economic history. Now, when one understands what's going to happen with regards to property, one needs to understand that you need to put the two together. Firstly, there's very low interest rates, and that's been passed on to the man in the street with regards to affordability. Secondly, supply cannot keep up with demand, both from population growth and from interstate growth. And therefore, you know, there's just a constantly growing demand where that problem is just getting worse and worse and worse. Thirdly, I think the thing that's very important is that one needs to understand what impact that's going to have on the states and the different states and the impact. And lastly, one also needs to understand that they've brought in this first-time homeowners allowance of $21,000 for anyone that buys property new from a developer. That's also had a big impact in the affordable sector of the market, the 300 to 500,000 bracket. It's really sort of dilapidated the land supplies, and that again is causing problems with regards to demand and supply. Now, I wanted to show you this graph here. This was basically brought out by BIS Shrapnel. Now, BIS Shrapnel is one of the leading economic forums with regards to property, and this was their prediction over the next 3 years. They believed that the Sydney property market was going to grow by around 19%, the Melbourne property market was going to grow by about 19%, Adelaide 19%, Canberra 17%, Brisbane around 16%, and then you've got basically Hobart, Perth, and Darwin. The important thing here is that they've also got the medium house prices. You can see that effectively Sydney is the most expensive city, and then you've got Canberra, and then finally you've got Perth and Darwin in terms of their medium price. So it's basically taking into account the affordability. Now, the most active part of the market is the $300,000 to $500,000 bracket. It's very easy to explain why. 85% of the Australian population lives in the middle class. The middle class, you know, the average wage is between $45,000 to $65,000. Now, when you take that into account and you basically say, right, they can borrow 6 times their earnings. So on a double income family, they're looking at borrowing, if they take husband and wife at $100,000, they'll be able to borrow about $600,000. But by the time you take off credit card, car finance, and all the other ancillaries, children, etc., they'll be in that $300,000 to $500,000 bracket. If you take a single family, you know, at $50,000, that's $300,000. 85% of the population is in that bracket, and that is where you're getting the best growth and also the best rental demand, because they've got rental floors and they've also got rental ceilings, and that is why we focus so heavily on that sector from the 300 to 500,000 bracket, because that is where we're getting the best returns for our investors. Secondly, from a South African perspective, one needs to understand the importance of investing now. The rand is strong at the moment. Also, when one takes the statistical average over the last 5 years, this is what I got from Yahoo Finance. It's very up to date, and you can see here the graph of the rand to the US dollar over the last 5 years. Here you can see the rand to the pound. Here you can see the rand to the Aussie dollar, and even the rand to the Kenyan shilling. You know, ladies and gentlemen, sure, this graph goes up and down, but the bottom line is it's following one trend. And I think statistically you need to understand that while inflation in Australia is around 4, 5, 6%, and inflation in South Africa is around 10%, while there's that 5, 6% gap, it's economic fact that over the medium to long term, the rand will continue to devalue against these first world currencies. But you know, the Chinese have a saying. They only have one word for crisis and for opportunity, and it's not all doom and gloom. I did a table here which takes into account the pound to the US dollar, which is actually the green line. You've got the Aussie dollar to the US dollar, which is the blue line, and you've got the rand to the US dollar. And what I did was I took this into account of basically over what's happened over the last 12 months. The pound is devalued by 19% against the US dollar. The Aussie dollar is devalued by 17%. And the rand is devalued by only 6%. So if you're a South African investor looking to invest overseas, looking to get into a first world economy with a first world currency, first world assets, and first world income, this is a fantastic opportunity because you can get in with a strong rand and you can also buy assets at low values. And I think it's very, very important to understand the impact that that has for you as an investor, because it effectively provides the perfect scenario. Strong currency to buy and yet low values, but with good growth prospects. The other thing that I think is important is that one needs to take into account what you can control. I'm very concerned about the rand. In a recent article in The Economist, it said that the South African economy was the most exposed economy in the world. That's taking into account the Brazils, the Argentinas, the Russias, the Lithuanias. We were the #1 most exposed economy in the world. Interest rates are coming down. They have to continue to come down, and the reason being is that we need to stimulate the economy here in South Africa. But what it means is that the foreign investors are not getting their returns and will take money out the country. We had the election on the 22nd of April, and to be fair, it went fantastically. I was concerned that the rand would have an impact, and it hasn't had an impact. But I think the important thing is that the ANC and COPE's election mandates were to have the rand to the US dollar at 12 rand to the US dollar. Now the reason for that was that it stimulates agriculture, it stimulates mining, and they're two of the biggest growth job segments in the country. Now if you take the rand is currently around 8 rand to the US dollar, that's a devaluation of a third, or 33%. What impact would that have to you, the individual? If it was to devalue between 10 to 25%, to buy an Australian home, you need roughly 700,000 rand. That's for your deposit plus all your costs, and that's for a nice 4-bedroom home. If it was to devalue by just 10%, that would cost you an additional 70,000 rand. If it was to devalue by 25%, it would cost you an additional 177,000 rand. Now, ladies and gentlemen, think of the impact that that has to you as an individual. I tend to say to people, and I ask them a question, do you think there's more chance of the Australian property market going down by 10%, or do you think there's more chance of the rand devaluing by 10% over the next 12 to 24 months? And that for me is one of the most crucial things as to what you need to take into account as to why now is the time you need to be looking at it, because you can control the variables now. You don't know where the rand is going to be in 12 to 24 months from now, and that is so important with regards to the affordability and actually getting into the market at the moment. If I was to continue, what one basically needs to look at next, which I think is very important, is the cash flow and how the numbers work, because this will really primarily explain to you why you as an investor, as a South African investor, needs to look at this particular investment. So I'm just going to change across here to my cash flow. It'll make life a lot easier to be able to see. So if you take this cash flow here, let me just zoom this in a little bit. This will make life easier. This is a generic cash flow. It's one that I work on across all my different properties, plus all my different countries. They're obviously specific for different countries. The important thing to look at here is that you're going to get a loan to value of 70%, generally between 70 to 80, but I tend to err on the side of caution. The Aussies talk in rent per week. They also talk in dollar per thousand per week. So if you're buying a property for $400,000, you should be aiming at around $400 a week. I've put it in there as a rent per month, and obviously you've got the yield. Now anything over 5% is a great investment because it means it will be cash flow positive from day one. You've got rental escalations at a roughly 5%, which is what it's statistically been over the last 10 years. You've got the interest rate. What you'll be borrowing at now is about 5.2%. It's roughly 1.9% above base rate, and base rate is 3.25, so you'll be borrowing at about 5.2. And then I took an average Australian home, $366,000 for a nice 4-bedroom, 200 square meter home. And I think that is, it just gives you an idea. The transfer duty, basically it's their transfer duty or stamp duty. On a house and land, you only pay on the land value of the property. There's no furniture and flooring because you rent the unit out unfurnished. The finance fees, that's what you pay to the bank to get the initiation fees. The legal fees, the nice thing in Australia is that you've got a lawyer that acts on behalf of the seller, and you've got a different lawyer that acts on behalf of the buyer. And that lawyer is there to protect you, to make sure that he does all the due diligence, that you understand the full process. And if he doesn't do anything in terms of the due diligence and something turns up, you can actually sue him later down the line. So you're very protected through the process. There's no body corporate fees because you own the property outright. You've got your rates and taxes. You've got your 10-year lease back at $15 a week. You've got your lettings and management charge at 8%. And then I worked on an exchange rate of R6.50, which is what it's roughly been over the last 6 to 12 months. This next box gives you an idea of the total capital outlay to buy that property at $366,000. You'll see there you've got the purchase price minus the mortgage at 70%. You've got I've spoken about all these things here. The only one I haven't spoken about is the completion costs. On a house and land, the land will transfer into your name, and then the house will be built, and there will be stage payments and interest payments. I don't like any surprises, so that $6,000 will actually include those interest payments until you get the keys and you can physically put a tenant in that property. So the total capital outlay to buy this property is $126,000. And sorry, with those completion costs, it also includes for a fully qualified surveyor to go in, to snag and check the property and make sure that everything is 100% ready for you to put a tenant in it. You would need $126,000. The next box basically breaks down when that's required. So the easiest way to describe it is that we work with developers in Australia. To secure the property, you need to put down a 20,000 Rand deposit. That goes into a South African trust account. It's subject to exchange control approval. It's subject to you getting your finance in place, and it's also subject to getting the FIRB application, all three of which we will help you through the entire process. Once that's in place, you'll need to send your first 10% across to your Australian lawyer's trust account. He will then let you know when you're actually going to settle on the land. It'll tend to be 2 to 3 months. When the remaining 20% will be in place, and that is when you'll need the 20% plus the final costs, things like stamp duty and the lawyer's fees. So it gives you an idea of the timing, and there you've got the dollar amount and the Rand amount. And then the last two things, and the ones that I think are most important, firstly, from a rental perspective, you've got the rental minus all the expenses. You can see that I'm very conservative. I've even got an insurance policy in place in terms of landlord protection insurance. But the nice thing, this property is cash flow positive from day one. Let me repeat that. You put down your deposit, you take ownership of the keys, your rental is guaranteed, and this property is cash flow positive from day one. The second thing that's important is people say, well, Scott, what is the rental, what is the growth predictions? I don't have a crystal ball better than anyone else, but I work on 5 years. I think it's a good idea with regards to scenario planning, and I work on 3 variables, 6, 9, and 12. The reason for it is that the 10-year average for inflation has been 6%. Property tends to track inflation even when property is moving sideways. The 100-year average is 9%, and the 10-year average is 12%. At a 6% capital growth over 5 years, you're making a 19.7% return on investment year on year. Not a bad return for a below average growth. But what's important for us as South Africans is that statistically, the Rand is devalued by 5% year on year against the Australian dollar for the last 15 years. So, if you're comparing apples with apples and taking R1,000,000 and investing it here in South Africa, or taking R1,000,000 and investing it offshore, you need to take that 5%, add it to the 6%, and over 5 years, the growth on your rand investment is 41%. Ladies and gentlemen, might I remind you that 6% capital growth is below the 10 and the 100-year average. If you take that BIS shrapnel, that is what they believe will be happening over the next 3 years. And even at that minimal growth, you're making a 41% return on your rand investment. And I think it is so important to understand that as with regards to why you as a South African need to be looking overseas, not only to invest in first world assets, but also as a rand hedge and an insurance policy. And most importantly, to secure your future going forward. So let me go back to my PowerPoint presentation. Hopefully you've understood the importance of the numbers. Now to give you some examples. This here is a 4-bedroom home. Its price is, you're looking at $304,000. This is in Melbourne. It's a 194 square meter home. The land is on 583 square meters. So it gives you an idea of a really nice, affordable Australian home to the west of Melbourne. Next, we've got a property. This is a 4-bedroom home. It's in Brisbane, just to the north of the city. The price is $384,000, 160 square meter home with the land on 320 square meters. Then you've got, this is a 4-bedroom home, $417,000. It's the house size is 195 square meters and on a land at 411. And this is an example of a property also in the Brisbane city centre. And then lastly, a lot of people like this picture because it really reminds them of home and gives them an idea of the type of property that they can buy. This is a big 4-bedroom home, $471,000. The house is 244 square meters and the land is 612 square meters. And the important thing is that this property is to the south of Brisbane, in between Brisbane and the Gold Coast, in a fantastic estate with everything that we'd be used to from a South African perspective. So it just gives you an example of some of the type of properties that one can expect and the rental returns and the demand and these type of properties are what the average Australian, more than 70% of Australians want to live in a 3 or 4-bedroom home. They move in, they like to stay there for a couple of years, and it's a good quality Australian, affordable Australian home to live in. This here is a double story. It's based to the south of Brisbane as well, 474,000, 197 square meters on a 313 square meter piece of land. And that there is your home. So it gives you an idea of just the type of properties, but you'll see that we focus on houses rather than apartments. And then, this picture just gives you an idea of the quality of the finishes. The one thing that I do say to a lot of my investors, one needs to really understand the quality that you're getting. Yes, you're buying an affordable Australian home, but importantly, it really comes with top quality finishes and, right down to things like the cornices. And the quality of the artisans in Australia ensure that this quality is top. And that's really important, both for now, for getting a tenant, but also for the future with regards to your capital growth and possibly selling the property in the future. So in conclusion, I mainly believe that there are 3 fundamental things that you need to understand before you invest. And IPS, we can help you in terms of understanding those 3 fundamental things. We can train you with them. The most important one for me is finding an area with regards to rental demand. And that is where you really need to understand what's going on in an area to find the best areas. The second one is understanding capital growth. It's a huge, huge country, Australia. You can fit South Africa just into one of their states. And you need to understand the difference between the states. You need to understand the difference between the cities. And then you need to delve down into the suburbs where you're getting the best capital growth. And I think that is really, really important to understand. And then lastly, you need to understand all the nuances of investing from overseas. Things like your tax, your financing, the process, managing the process, and IPS can help you with an end-to-end solution right through that particular thing. So if I go back to the PowerPoint, I'll actually show you in terms of the next steps. When you finish this seminar, there'll actually be a feedback form. Please fill it in. It tells me what you're looking for. It tells me what you liked about the presentation. It also tells me what you didn't like. We've got the cash flows On the website, we've got a market review which you can download. But what I would highly recommend is next to sit down with one of our property professionals, and so that we can understand what it is you're looking for. We can explain the market to you, and we can help you find solutions. We can help you choose a property. We can help you arrange your financing. We can help you with your exchange control approval. And then through the purchase process, we can help you manage the entire thing with regards to the lawyers, FIRB, the developers, inspections upon completion, and then ultimately management. It really does provide you with an end-to-end solution. And you know, the saying that Oz Invest have is that they provide their investors with a remote control solution. Remember the 40 soldiers that they currently have in Afghanistan buying property back in Australia. And IPS, along with Oz Invest, provide you with that end-to-end solution. We work together. We split our commissions 50-50, and therefore for you, whether you're sitting in South Africa, whether you deal with Oz Invest directly in Australia, or whether you're an Australian just living in Australia, it doesn't cost you a cent more. And I think that is so important to understand. We provide you this full solution as if you were an Australian living in Australia, just like Oz Invest do for all their Defence Force people around the world. One thing that you really need to understand as a South African, there's a recent statistic that came out, 90% of people in developing economies get seriously affected when currency fluctuates. That was looked at in Argentina, it was looked at in Russia, and it was also looked at in Zimbabwe. And you know, the only people that are not directly affected are those wise and prudent people that had offshore assets, offshore income, because they were protected from the currency fluctuations. It really is important to understand that, and to understand the impact that that will have on your future and your family's future. So, you know, in conclusion, I bring you back to that picture. Preparation determines how much you enjoy your experience. Whether you're going to live in Australia or whether you want to live in South Africa for the rest of your life, fantastic. But you need to prepare now for your future. You've got our website there, IPS Invest. I will actually just send that out, because I personally have found that it's easier just to be able to link. So let me just send that through to everyone, ipsinvest.com. If you go onto there, we have everything that you would be looking for. We've got FAQs, we've got market analyses, we've got cash flows, we've got recent reports. If you go onto our blog, which is also on our website there, ipsinvest.blogspot.com, we've got full thorough analyses as to what's going on in the Australian market. There's so much information. And then we've got the opportunities that you can go through and understand, you know, fully as to what the different properties are, what the areas are, and how to go through it. But as I said to you, I would highly recommend that you come and you talk to one of our property professionals who can take you through the process. A bit of good news, we really are stuck in rugby fever at the moment. We're giving away 2 tickets to the British Lions versus the Springboks. A bit of extra incentive, go to our website, and for free you can enter those competitions. So, you know, without further ado, I hope that I've been able to really give you a thorough analysis as to what's happening within the Australian market. My most important thing was to provide you with information so that you could understand the Australian market. And when you're ready, we have solutions to help you invest in the market. We've got the areas that get the best capital growth. We've got the areas with the best rental demand. And ultimately, we can help you get the best return on your capital, the best return on your investment. And that is going to help you not only with a rand hedge, not only with an insurance policy, but ensure that you will have a better future, not only for yourself, but for your family. I want to thank you very much. And I always say at our live seminars, no matter what, put a smile on your face and be proud to be South African. I'm not going to take any questions. I'm not sure for the guys that are online, if you want to send me through any questions, the best way to do it is to effectively click on the question poll and send them through. Okay, ladies and gentlemen, well, it looks like tonight that in terms of the questions, I don't see any questions coming through, which is either a good thing, I've bored people to death, or hopefully tonight we've been able to answer everyone's questions. So I hope that you've really enjoyed the presentation. I hope that in the future we'll be able to assist you. If you've got any questions, please go to that website, www.ipsinvest.com. We've got all the details there. Or give me a call, 011-463-0588. I do look forward to it. I thank you very much for your time this evening. Have a great evening, and most importantly, keep that smile on your face and be proud to be South African. Thanks for your time. Cheers.